What if I told you that the single worst investor in modern financial history still retired as a millionaire? Not because he got lucky, not because he had some insider information, but because of one brutally simple thing he refused to stop doing. Stick with me, because by the end of this video, the way you think about investing will never be the same again. Let me introduce you to a guy we'll call Marcus. Marcus is a hard worker. He saves diligently. But Marcus has a crippling fear of losing money. So instead of investing, he watches. He waits. He tells himself he'll jump in when the time feels right. And every single time he finally convinces himself to invest, the market collapses almost immediately afterward. We're talking about buying right before the brutal crash of 1973 and 1974, when markets lost nearly half their value. Then doing it again, right before Black Monday in 1987. Then plowing his savings in at the absolute peak of the dot-com bubble. Then making one final catastrophic investment right before the 2008 global financial crisis. 4 swings, 4 direct hits. The world's worst timing, executed over 4 decades. You'd expect Marcus to be broke, right? You'd expect him to be bitter, working into his 70s with nothing to show for it. But when Marcus finally retired, his portfolio was worth over $1 million. He turned roughly $184,000 of contributions into a 7-figure nest egg. And today we're going to break down exactly how that happened and what it means for your money right now. The core principle that saved Marcus is something most people intellectually understand, but emotionally never act on. He got the timing completely wrong, but he got the time in the market completely right. Every single time his investments crashed, Marcus did not sell. He felt sick. He probably lost sleep, but he held on. And that stubbornness, that refusal to panic out of his positions, is what allowed decades of compounding to do the heavy lifting. His 1972 investment sat in the market for over 40 years. Even though it got cut in half almost immediately, it compounded quietly and powerfully for the 4 decades that followed. That's the engine nobody talks about. Now let's compare Marcus to 3 other types of investors to really drive this home, because the contrast is going to shock you. First, we have the fantasy investor. Let's call her Elena. Elena has a crystal ball. She invests the same total amount of money as Marcus, but she always buys at the absolute bottom of every crash. She's catching the floor in 1974, the bottom in 2002, the exact low in March 2009. The mathematical result of her perfect timing is roughly $5 million. So here's the thing that will blow your mind. The worst investor imaginable ends up with $1.1 million. The absolute best investor with perfect timing ends up with $1.5 million. The gap between flawless execution and total incompetence is surprisingly small. Being terrible cost Marcus less than $500,000 over a lifetime of investing. That's not nothing, but it's also not catastrophic. Then there's the consistent investor. Call him James. James doesn't watch markets. He doesn't follow financial news. He just automatically invests his savings every single year the moment he earns it. No timing, no strategy, just discipline. James ends up with around $1.3 million. He beats Marcus because some of his purchases naturally hit lower prices, but he trails Elena because he never catches the perfect bottoms. James represents the power of pure automated consistency. Now here's the character that should keep you up at night. Meet Derek. Derek is clever. Derek watches CNBC. Derek reads headlines. Derek says the market looks overvalued and decides to wait for a better entry point. Unlike Marcus, who at least eventually pulled the trigger, Derek keeps waiting. Or Derek buys, sees a small dip, panics, sells to preserve capital, and goes back to cash. If Derek spends his career sitting in savings accounts and treasury bills instead of the stock market, he ends up with somewhere around $400,000 to $500,000. Marcus, the guy with the worst timing in recorded history, has more than double what Derek ends up with. The prudent, careful, headline-watching Derek gets absolutely crushed by the guy who bought every peak. This is the most important lesson in this entire video. It is better to invest at the wrong time than to never invest at all. The cost of sitting in cash waiting for the perfect moment is far more expensive than the cost of buying at a peak. Here's why this matters even more than you think. Research on market returns over 20-year periods shows something terrifying for anyone trying to time the market. If you held an S&P 500 index fund for the full 20 years, your annualized return was around 11.8%. Solid. But if you missed just the 10 best days out of approximately 5,000 trading days, your return dropped to around 9%. You lost nearly a quarter of your annual returns by being out of the market for just 10 days. Miss the 50 best days, which is just 1% of all trading days, and your return collapses to roughly 2.4%. You barely keep pace with inflation. The entire wealth-building power of the stock market is concentrated into a tiny fraction of trading days. If your money is sitting in cash on even one of those days, that return is permanently gone. Now you might think, fine, I'll just avoid the bad days. But here's the nasty reality. The best days and the worst days in market history are practically neighbors. Research from JP Morgan Asset Management consistently shows that a significant portion of the 10 best days in any given period occur within 2 weeks of the 10 worst days. Crashes and recoveries happen in violent sequence. If you panic sell during a crash and move to cash, you almost always miss the ferocious snapback rally. You lock in the loss and miss the recovery. You have to be right twice to win at market timing. You need to sell before the crash and buy back in before the rally. Almost no one has the psychological fortitude to buy when everything still feels like it's on fire, which is exactly when the best buying opportunities exist. Dalbar research consistently shows that the average retail investor underperforms the very index funds they invest in by 4 to 6% annually, not because of high fees, because they keep jumping in and out trying to be smarter than the market. So what do you actually do with all of this? The strategy is simple, even if it's emotionally uncomfortable. You invest consistently. You invest automatically. You treat every paycheck like it has a standing appointment with your brokerage account. You stop trying to time the entry and start obsessing over your time in the market. If you're already doing this and want to accelerate your path to genuine financial freedom with a structured approach, check out the Wealth Accelerator Academy in the link below. It's a group coaching system and full course designed to help you build and execute a real wealth-building strategy, not just theory, but an actual personalized roadmap. Now let's talk about the lump sum question, because I know someone watching this right now has a chunk of cash sitting on the sidelines waiting for the market to pull back before deploying it. Research by Vanguard comparing lump sum investing versus spreading investments out over 12 months across multiple markets found that investing the full amount immediately outperformed the gradual approach about 2/3 of the time. Because the market goes up more often than it goes down, spreading out your investment usually just means you buy at progressively higher prices. You pay an emotional comfort premium in the form of statistically lower returns. That said, if investing a large lump sum all at once will make you panic sell at the first 5% dip, then spacing it out over 6 months is the smarter psychological move. The worst outcome isn't a suboptimal entry price. The worst outcome is bailing when things get rocky and permanently locking in a loss. Let's bring this all back to Marcus. Marcus was not a genius. He had no strategy. His timing was objectively a disaster every single time. But Marcus did one thing that most investors never manage to do. He stayed in his seat when the roller coaster dropped. He didn't have a sophisticated exit strategy because he never intended to exit. That stubbornness, that refusal to let fear drive his decisions, compounded quietly across 4 decades into a $1 million outcome. The financial media exists to make you feel like you need to do something. Move your money. Protect yourself. Get out now. Buy this. Hedge that. Every alert, every breaking news segment, every doomsday prediction is engineered to make you act. But the data on Marcus proves that inaction, strategic, persistent, stubborn inaction, is one of the highest value moves available to ordinary investors. You don't need perfect timing. You don't need a crystal ball. You don't need to be the smartest person in the room. You just need to get in and stay in. Stop trying to be Elena with her perfect entries. You will never be Elena. No one will. What you can be is Marcus, consistently invested, stubbornly patient, and a millionaire at the finish line. If you're ready to take that principle and build a real structured plan around it with coaching, accountability, and a proven framework, the Wealth Accelerator Academy is exactly that. The link is in the description. It is the difference between knowing this information and actually living it out in a way that builds lasting financial freedom. The only investors who truly get hurt in a long-term market are the ones who jump off while it's moving. Stay in your seat. Let decades do what they do. And remember, you don't need to be brilliant to build wealth. You just need to not be Derek.